Hello, I'm 𝗙𝗙𝗖𝗋 and this is my biased post-earnings analysis of Warner Brothers Discovery stock. Now, if you want to know my unbiased thoughts on these earnings, I did a video before the earnings release based on what my expectations, my minimum requirements for the stock were. So if you want to go watch that first, go now and then you can come back here. If you don't want to go watch that video, here are the highlights. I wanted our cash position to increase, and it has, from 3 billion to 3.6 billion. And our debt due over the next 5 years has gone from 23.8 billion in Q2 2023 to this quarter 21 billion. So almost a 4 billion decline from this quarter last year. If you want to see these numbers, guys, I have a link in the description to my debt model spreadsheet, and I've updated it so that it's far more automated, so way less human error. And so what it does is what you can do in just a click, you can switch between all the different quarters, all the quarterly different earnings and those debt schedules. So what you can do is you can see really quickly, you can compare how much debt is due in the next 5 years from Q2 2022 to Q2 2024. So this was the big thing that I wanted to see this quarter, and it's not a huge reduction from last quarter. It's a fairly significant reduction from this quarter last year. However, we're going to get more into this in a minute. The next thing I said in my last video, in my pre-earnings analysis, was I wouldn't be too concerned if the revenue had reduced by up to 7%. So my base limit, my sort of the point at which I would not panic, was a 7% reduction in revenue. And what we ended up having was a 6% reduction in revenue. So we are just slightly above my sort of worst case scenario. Finally, and this is a big one, we had a 50% reduction in free cash flow from this quarter last year. Now, this is significant because even in previous revenue reductions, we've still had continuously increasing free cash flow. And to be fair, our 6-month free cash flow is still up year over year. Free cash flow is really important because even though it represents our earnings after paying down our interest payments, it's still a reflection on how capable we are in paying future interest and future debt. Now, after this 50% reduction in free cash flow, we are still able to pay our interest payments another 2 times over this quarter. So to run it all over, these are the highlights. Our cash position is stronger, our debt position is stronger, our revenue position is worse, and our free cash flow position is worse from a year ago. Now, up until this point, I believe everything that I have said has been a fact. So from here on in is going to be my interpretation of these facts. So obviously this is the bit that is going to potentially trigger anyone. So here is a trigger warning, and I am saying right now that I am biased. So I'm going to, in a lot of these cases, I have a positive interpretation of these facts. So I have my own interpretation of these numbers, and I'm very aware. I see them in a positive way, but I'm aware that I am biased. I'm aware that I hold Warner Brothers Discovery stock, and that I have to acknowledge that I want this stock to do well. So that is obviously going to influence me in my interpretation of these financial results. So you have been warned, and now let's get on with my analysis of these earnings. But before we get into that, I do want to talk about the fact that I am a popular investor on eToro. What that means is if you take 5 minutes to download the app, you can copy my exact trades on the eToro platform. You can even see my performance over the almost 10 years that I've been on the platform. And if you go to the incredible site 𝗙𝗙𝗪𝗧, this site is beautifully made. You can actually see my performance over the 10 years compared to the S&P 500, where I have outperformed it by almost double, and over the last 5 years I've gotten about 141%, where the S&P has gained 80%. Now, I want to be totally clear, I don't benefit directly from you copying me, but I do benefit from having a larger amount of assets under management. I will have no control over your money. It will be in your account. The only thing that I will control is what I invest in, and you will simply be copying that. I take absolutely no commission. eToro as well is a fully regulated UK London-based company that is FCA regulated, and if you go to the FCA website, you can see eToro listed on there. I want to be really honest and transparent about how this benefits me. The more assets under management I have, if I have over 50k assets under management, then I get about $250 to $500 a month from eToro, And the way that where that money comes from is eToro make money from obviously having a lot of cash and a lot of assets stored on the platform, and a bit like a bank. This is kind of them. They are rewarding me for drawing money onto the platform and helping and incentivizing you guys, because theoretically I should be making you guys money. That would be incentivizing you to keep that money and keep those assets on the platform. So this is a reward for that. They're not taking commission. There is, I believe, there's got to be a tiny commission that they take in the spread. They say it's zero commission. When I look at the spreads, they are all so close to what the spreads are on the London Stock Exchange. So potentially they don't take any commission from the spreads. It's just from having your money stored on the platform. Just the same way a bank will give you a savings bonus for keeping your money inside a bank. I actually had over 50k assets under management in 2021 when there was a giant bull run, and then when the interest rates went up, my portfolio suffered, and then quite a few people left me. I didn't want to go shouting, trying to drag people into my portfolio after a big decline, because I just think it reeked of, like, I don't know, I just didn't want to do that. I wanted to prove myself first, and I now feel 2 years out from that dip, I had a 20% increase and a 15% increase. I believe I've proven myself. I also made, I want to be completely transparent on this, I made a big mistake with Cineworld, and fortunately that didn't crush the entire portfolio, but it was a big learning moment for me, and I didn't want to immediately start calling people back into the portfolio right after making a mistake like that. I'm super grateful for the people that stayed with me, because we are now we're coming close to all-time highs again, just 2 years later. So again, I'm not going to complain about people leaving me. I think that's totally fair, and I now like to think that my portfolio performance speaks for itself. Go there, check it out, and decide for yourself. I'm not trying to force you guys to do this. It's just, I think, the best way for you guys to support this channel, rather than me saying, oh, buy me a coffee or pay me £3 a month. I think this is like a real way, because obviously if you copy me with just $200, what you can also see is how I am actually performing. And so if I'm not making you money, then perhaps you shouldn't be listening to me. I also don't want to encourage people to do this when the portfolio reaches all-time high or experiences some sort of epic bull run. Right now we have Crocs that is beating revenues, but at a price to earnings of 10. We've got Warner Brothers Discovery, which I'm about to get into, and we've got Alibaba that is so crazy low. So I think this is a really exciting time to copy me. But again, I'm not asking you to do this so that you can be rich, so that I'm not saying invest all your life savings into me. I'm saying come join me on this journey, support the channel, and help me keep creating videos, keep learning, but also potentially I might be able to help you guys save more money at the same time. I want to be like Buffett. I don't want to go around telling people to invest in my fund. By all means, what you should be probably pouring most of your savings into, if you're pouring your savings into stocks and shares, you should be pouring them into something like an index fund like the S&P 500. But I think it would be cool if you've got a small amount of money on me and it's doing badly or it's doing really well, then I think it adds credibility to this channel that I'm doing. I either have to learn from it because I know that the people subscribed to me can see my returns, so it creates an added credibility and added pressure on me to create quality content. I really don't want to start creating YouTube videos built around entertainment to try and drive up subscribers, to try and build up revenue on the channel. I think this would be a much better way getting money from eToro to support this channel, rather than trying to get it from you guys directly. And one more thing, if you are thinking I don't have $200 to put into this to copy this guy, please don't feel any pressure to do this. I'm super grateful. I can't believe that I have 1,300 subscribers and over 140,000 views. That blows my mind, and I'm super grateful that you are just here. So don't feel any pressure to put any money on copy me on eToro. And if you do copy me and you decide to put more than $200, or if you want to put even more, fantastic. Thank you so much. That would be absolutely awesome. If you're wondering how much to put down, the only advice I'm going to give you is I'd much rather you put a small amount that you're super comfortable with, and you follow me on this journey until we are all as old as Warren Buffett, and we are talking about, and there are people talking about me and talking about us as if like, oh, what if you'd put £1,000 on Harry back in 2024, this is what it would be worth today. That's where I want this portfolio to get to. It's 60, 80 years time. That's what I'm thinking about. So yeah, I'd love for you guys, I really feel like this channel is on the start of its journey. And if you want to be part of that journey, I think this is an awesome way to do it. But also liking and subscribing is really cool too. So I've really rambled on this. I'm sorry about that. Enough said on that. Let's get back into the video and into Warner Brothers Discovery's debt. I think a lot of people in the comments and that I talk to online don't realize that had we have not gotten our debt from the merger of Warner Media and Discovery under control right at the beginning in the early 2 years, what we could have right now is still a revenue reduction and still a free cash flow reduction, because we could have still had the strikes and we could have still had other issues. We could have had NBA issues because they were asking for an awful lot of money for the NBA. We could have had all these issues still, but also an unreasonably large amount of debt, because when we began the merger, we had 13% of our debt was variable rate, and that could have shot up way more. Like, we've had a 6% revenue reduction. Our variable rate debt could have potentially gone up by more than 6%. So we could be in a much worse position today if our variable rate debt, or just our debt in general, had outgrown our revenue. There was a conscious choice right at the beginning of this merger to prioritize stability over revenue growth, a choice that I fully support and is extremely rare in Wall Street. And this is what I find really interesting. Ever since I updated my debt model sheet, I've been looking at the 5-year net debt that we had to pay back, going back to Q2 23. And when you go back to when the merger first happened, the market capitalization was around 60 billion. And obviously the debt that was due in the next 5 years was 32 billion. That means that the overall value of the company, if you bought it then and intended to hold for the next 5 years, was around 90 billion. And adding in the debt is a really important thing to do, because if you bought a car on finance and you paid 10 grand for it up front and then had a bunch of finance payments to pay, you wouldn't just say this car costs 10 grand. No, you would add the finance payments. You might adjust them for inflation if you're being really particular, but you would add the finance payments to the cost of your down payment, and that would form your interpretation of what the actual cost of that car is. So when you're looking at the share price of a stock, generally speaking, if it's got a significant amount of debt, which most stocks do after a merger, then you need to add that in to the share price, because you are going to be paying that. On a lot of stocks, debt is very, very low or spread evenly across its lifetime. A lot of companies just have a general amount of debt that is constantly on their balance sheet. In these situations, you don't really need to worry about debt. You just worry about free cash flow in general. But this is why mergers and acquisitions particularly are kind of seen as their own subdivision in investing anyway. Mergers and acquisitions kind of break the stock market, because what should happen, right, as you're paying off the debt, is that the share price should go up to compensate. So if you pay off 10 billion in debt, what you would expect is the share price to go up 10 billion, because the people that bought that share initially should have added that into the formula, right? They should have gone, okay, we're going to be paying back 10 billion after buying this stock, so we want 10 billion off the share price. That only makes sense. This is what would happen if the markets were logical and rational. As our 5-year net debt went down and our overall net debt went down as well, our share price would go up. But we've had the opposite experience. We paid off huge amounts of debt. We've gotten our 5-year debt way down, and up until these last 2 quarters have only been seeing our free cash flow go up. And revenue as well. Our revenue has only been going up right up until these last 2 quarters. Now, there are only 2 reasons that our share price should be going down this much if we are paying off this much debt. The first is if we were borrowing money in order to pay off this debt, but that's not happening. Our overall debt has gone down from 91 billion to 72 billion. The only other reason is a decline in the overall business, which after a merger or acquisition would be least likely to show up in the book value and the earnings of the business. After a merger or acquisition, these things are going to be hit hardest by depreciation and amortization, because if you spend $50 billion on something, you'd be such a fool to not use that $50 billion purchase to discount your earnings for tax purposes. You use depreciation and amortization to take $50 billion of revenue off $50 billion of earnings off your future earnings, and that way your earnings are tax-free and you can use it to pay off the debt from the merger or acquisition. That is why it's going to be at least 5 years from the merger that we begin to have earnings on our balance sheet, because we are going to be depreciating our free cash flow by 50 billion. So until we've earned 50 billion, we are going to have no earnings on our balance sheet. But this is just a paper loss. So it's going to be in about 5 years' time, we are going to have this sudden explosion in our paper earnings on our balance sheet. Of course, there's going to be real depreciation and amortization. If you release a huge blockbuster, it's going to make a huge amount of money the first year, and gradually over time it's going to make less and less and less. But shows like Friends, well, we licensed that to Netflix for $100 million a year, and in 10 years' time, I'm willing to bet, that is this bet for me, that roughly the same amount of people are going to try and tune in to watch Friends. Friends' audience isn't shrinking. When I have kids, I'll probably show it to them as well. And the same goes for the Harry Potter films, same goes for Lord of the Rings. I'm going to keep coming back to these things. How many people probably still watch Jaws every year? God, I just keep thinking of new ones. Gladiator is another epic that I will always come back to. Warner Bros. Discovery have 200,000 hours of content, and it doesn't matter that whether they are broadcasting it themselves on the streaming website or on a network, or if they are just licensing it to streaming platforms like Netflix, Amazon Prime, and Apple Plus. They will always be able to make money from this content because people are always going to come back for it. Just like Coca-Cola. Coca-Cola do not need to have their own supermarket. They can just sell the product to the supermarkets. And if we want to, we can always just sell this content to the supermarkets. That for me is Warner Bros. Discovery's moat, and that is why in one of their worst quarters of the year, 2 quarters out from when they had an entire quarter where they were making no productions, no film or TV whatsoever, they still had $1 billion in free cash flow. But yes, a 50% decline in free cash flow is hugely significant and not something that I take lightly. But I do want to say, last year we had a 5% increase in revenues, a 100% increase in free cash flow, and a 30% reduction in our net debt due in 5 years, and we still had our share price decline by like 1/3 to 2/3. This is what took the share price from irrational to insane. It was after that we got this 5% increase in revenues, this 100% increase in free cash flow, and this 30% reduction in net debt due over 5 years that I added a significant amount to my position, because this is when I was like, this is absolutely crazy. And then when in the next quarter we had the actors strike and we were going to pay off even more debt, I was like, this is fantastic. However, when the actors strike was happening, I think I said it in a video, I definitely know I said it in a video, that this is going to impact our future revenues. If it doesn't, that is a miracle. And it has, okay? It's affected our revenue by about 6%, and it was obviously going to significantly affect our free cash flows. If we didn't have a revenue reduction after an entire quarter with an actors strike, then I don't even know what we're producing new film and TV for. We should just be licensing all the old stuff. Now, if you're like me and believing that we should be creating new stuff, we should be doing a DC studio, and we should be creating new exciting content, and that is also one of the things that I'm most excited for David Zaslav. Once he's got the business under control, his emphasis is on creating original content. So not just doing endless remakes. Obviously you do remakes still, but he does want to be creating original content again, and I definitely think that is what we need. We need to less NBA, more Lord of the Rings, not literally more Lord of the Rings, but more Lord of the Rings style projects. By the way, guys, that is 100% David Zaslav's end goal, is to get the company back to a point where they can start investing big in those things with much lower risk. Again, in 10 years' time, I expect the amount of people to be watching our legacy content, Friends, Harry Potter, Rick and Morty, all of that stuff, will be roughly the same, if not just slightly more. And if they are watching that D2C on HBO Max, then that's just a bonus. The other thing is networks are dying. Network revenues are going down, they're going to continue to go down, and the only reason networks look so damn profitable right now is because the billions that we invested into it were invested many decades ago. And so now we're just reaping the rewards of all that infrastructure, and the absolute right thing for us to pump that into is the D2C business, but we don't need to rush. We just don't need to rush. We can pay off our debt. The big thing about being the biggest streamer in 10 years time is about being here in 10 years time. And that is why it is such a good thing that 100% of our debt is fixed at around 4.6%, and we are paying off so quickly. At some point in the next 5 to 10 years, two things are going to happen simultaneously. First, and this is going to happen really soon, but our 2-year free cash flow is going to be more than what we owe in debt over the next 5 years. And then the second thing that's going to happen is our depreciation and amortization is going to run out, and that should be a sad thing for investors, because we won't be able to discount our earnings anymore, and we'll have to start paying more in taxes. But until that doesn't run out, this is the absolutely best time to be paying off large chunks of debt. But the great thing for us when we do run out of depreciation and amortization credits is that then when the paper earnings of the business start to go up, the amount of money that if someone's got $1 million or of Warner Bros. Discovery shares, right now that has no earnings. So borrowing against that $1 million of shares is really high risk. So a bank is going to give you a really bad loan for borrowing against that $1 million worth of shares. If the earnings go to $1 a share, then $2 a share, then $3 a share, then a bank is going to be able to lend you more money at lower risk. When that happens, the share price is going to go up because the shares are more valuable. You can borrow more money against those shares. So when the earnings per share starts to go up because there are no more paper losses that we can discount against them, then they are going to explode because they have actual tangible borrowing value. This will be the watershed moment for the stock, when the depreciation and amortization runs out. When that happens, the amount of debt that is left on the business's balance sheet is going to be so low, and I just believe that these two things are going to compound in such a way that first you have this huge earnings explosion. Theoretically, there is a ceiling of around 7 billion that we will have in earnings. That would mean that we have a price to earnings of 3, but even assuming a price to earnings of 5, if we then start to see earnings growth because we are investing really well into original projects and not wasting money renting the NBA, then we will start to see, on top of that, earnings growth. Then we will potentially see a high multiple as well as that price to earnings of 5. And then what will follow from that is basically boom. By the way, guys, the alternative narrative to all of this is that network revenues are dropping, and in 5 to 10 years' time, no one's going to want to watch Friends or Gladiator or any of that, these things that we just rent out. But basically, Friends, Rick and Morty, this 200,000 hours of content would not be able to service its debt. I think that's insane. For that to happen, our interest payments and our principal and notional payments would have to go up to such an extent, they would have to triple next year, and our free cash flow would have to go down significantly. So yeah, guys, that is my interpretation of the financial statements, the most recent one. They weren't good, right? Okay, what we want is way more fun to watch revenues and free cash flow go up, as well as paying off huge amounts of debt. You don't want to see any of these things decline, but my interpretation of them is like, it's a little bit like, what the hell did you expect? We had an entire quarter last year where we paused all production. That was going to affect us at some point. If you don't believe that's affecting us now, if you don't believe that's what's causing this right now, then you're crazy. And if you think that we should have tried to end the strike earlier, did you see how much debt we paid off last quarter? We easily saved more than the 500 million that we have lost in free cash flow this quarter. So this is going to have to be a serious long-term issue before paying off that debt isn't worth it. Now guys, this is going to be my last video on Warner Bros. Discovery for a while, because I've made so many on them recently. They seem to be performing really well. You guys seem to want to hear about it. My next video next week is coming out, is going to be based on Alibaba's earnings. So yeah, tune in for that next week. I might do what I did last time for Warner Brother Discovery where I do a pre-earnings expectations video. And so yeah, look out for that the Thursday after this one, that this goes live. And yeah, so the next one will be Alibaba, and then this isn't an Alibaba and Warner Brother Discovery channel. So my next 4 videos I'm going to aim to do on completely original stocks that I have not done any content on for before. So if you want your stock to be analyzed by me, then make sure you leave your ticker in the comment section and I'll give it a look. Try and put something along with your ticker, bit of your thesis, why you were interested in this stock, so that it just stands out a little bit more, because if there's an interesting story behind it, I'm way more likely to want to click on it. But the thing that you should really do if you want to be rich is